Okay, without further delay, it's a great pleasure for me to introduce our speaker today. Just a little brief about him. He's a co-founder, partner in Charge Ventures since early 2015. And he is also invested in startups from various sectors, mainly in New York City. Marketplaces, VR, AI, messaging, healthcare and logistics, and etc. And he is he has been a local partner with Parker Lane Group, a technology-enabled returns management solutions company based in London. He was also an investment manager at Atlas Global Ventures, a PE house where he focused on healthcare and F&B companies. Prior to that, he worked as a business development manager in Alpha Trading and Shipping Agencies, a leading Saudi Arabia food commodity agency. He has built his own social gaming network and digital signage companies. And finally, he's also a volunteer with African Impact and has visited Africa several times for different projects. He has spent significant time in the US, Middle East, and Greece. So please welcome Chris Habachy.
It's on? Yes. Okay, thank you guys. It's a pleasure being in Malaysia for the very first time ever. So I appreciate the invitation. And I think you know everything about me now. So, okay. So, as the very nice lady said, I'm a partner with Charge Ventures. A couple of things about Charge. Charge is a New York City early stage VC fund. Why we chose to focus in New York City? It's kind of simple, it makes sense. Basically, what happens is that, you know, for an ecosystem to be evolved, there are three things that are necessary. What are those? I mean, you need capital, which is money. You need talent. You need the people that will build the, you know, the next big thing. But most of all, you need something that up until recently it only existed in the Valley, which is culture. So no other place in the US and I think in the world up until recently had culture. And by meaning, you know, culture, we mean that, you know, a couple of guys are gonna, you know, have an idea and they will believe that they can build the next billion-dollar company. And, you know, in San Francisco and the Valley, you could see that happening with people that, you know, you see them in the coffee shop and then they start a company in a garage and then, you know, a few years later, this company is worth a couple of billion, and you see them and you know them and you believe that you can do it too. That's what culture is. So that happens. What happens now is that also in New York, what happened in 2008 when Lehman collapsed, it started to have these new startups that became bigger and bigger. And the way that this happened is that if I'm a student, you know, in Harvard and Yale and Brown, and I graduate from an Ivy League school, I'm gonna wanna be, you know, investment banker if I wanna make any money, or I wanna be a corporate lawyer, or I wanna be a consultant. But in 2008, you know, these jobs, you know, evaporated and they disappeared. So what did people do? They became entrepreneurs and they started their own company. So since 2008 and 2009, lots of companies started in New York, and since then we've had $1 billion IPO almost every year. And that now has created, you know, an ecosystem in NYC. A few of these companies that you might know are, you know, Etsy, Tumblr, On the Capital, and now you also have WeWork. That's, you know, it's not public, but it will be. So it's an ecosystem now that has also the talent and the capital, but also the culture. So that's why we are focusing there. So Charge was founded in 2015. We're very happy to, you know, for the team that we have and the partners that we have, and also we co-invest alongside the best funds in the US, including NEA and Kleiner Perkins and, you know, first round SV Angel and others. Up until now, we have 21 investments in our portfolio, a total of 28 along with the follow-ons, and we're very happy that our follow-on rate is approximately, it's more than 70 or more percent until now. And we have a geo focus, as I said. We focus in New York, and we also have a stage focus. We only invest in pre-seed and seed stage, but we're sector agnostic as far as the sectors that we invest at. So until now, we've invested in places like VR, marketplaces, artificial intelligence, messaging, healthcare, fintech, security, and others. And to go and finish with this, we deployed our first fund, and now we're in the process of raising our second. Hopefully, we're going to close it in the next month or two. These are some of our companies. I'm going to jump into detail on a couple of those later when I speak about it with examples. So I'm going to talk about what is it that an investor don't want to see in a deck and don't want to see when they meet with founders. So I think if any of you are startup entrepreneurs, you might find useful what it is that we're going to be talking about today. A couple of things to keep in mind here. These are my opinions, so these opinions don't represent that of my partners at Charge Ventures. And the second thing is that the early stage investing, as you may have heard, is more art than science, meaning that in later stage investing or in private equity, you deal with numbers, so you get a balance sheet and a P&L, and you can judge if an investment is good or bad. In early stage investments, you don't have this kind of number. So it comes down to, do I like the guy that is building this company? Do I believe the guy is going to make it? Is the market big enough? And then, you go and you trust on your gut, and then you take a bet. As simple as that. So what I want from you guys when you leave this room after this presentation is to get a few giveaways. And number one is I want you to know what to ask when you're going to go out and ask for money. Then I want to know why. I want you to know why you need the full package. Okay? I want you to know what investors don't want to see, but also what investors do want to see from your deck and from you personally. I want you to be able to start selling your product much better, but most important, I want you to get smarter on the whole process, okay? So, the way I see it, I see 4 things that I care about when looking at a deck or looking at a startup. The first one is the team, the second one is the market, the third one is the product, and the last one is the fundraise. So, let's start with the team. Meaning the team, is it, do I see the people that I believe that they can make it, and can they do it? It happens so many times where I see people that come to me and they come with a fantastic idea, in a big market, but they don't have a team in place. They're just alone, and they say, I'm going to find the team. No go. The first thing that somebody's got to do, you got to find your co-founders. Investors want to see manpower. And by meaning manpower, they want to see a complementary skill set, things that, they want to see a person that is able to execute. They want to see a person that has the vision and the strategy of the company. They want to see a person that, is able to go and write code, and be the techie guy. They want to see a person that will be administering and executing on various daily things. I want to see someone who knows how to recruit and someone who knows how to fundraise, because knowing how to go and get some money is also very important. And you cannot scale fast enough if you don't have a team, because startups today, yes, it's a marathon because you got to do a lot of things well for a period of time, but also it's a race. So you got to do it much faster and better than the other guy, in a limited time. And what happens also is that in startups, there's always the risk that the founder is going to burn out. Okay, he's going to get tired. He's going to see difficulties on the way that he can't deal with. He's going to be like, oh, I can't do this anymore. So if there's a sole founder, that means that a company is done. But if there are a couple of more, it means that somebody else can pull the weight. And keep in mind, guys, that no one has made it on their own. It used to be back in the dot-com era about a decade ago or more. It used to be that it was a formula of two founders in a company. So it was the MBA guy that dealt with the business side of things, and there was a technical guy that dealt with the technical side of things. Well, now, since 2008 and 9 and after, there is a third guy. It's a formula that favors three guys in a team, and basically says that besides the business guy and the techie guy, what's also important is a design guy. And design has been a very important aspect of a startup nowadays. In general, if you want to build a team, my advice is you got to find some people who are smarter than you are. Don't be afraid of smarter people. Don't be threatened by people who can do things that you can't. They're gonna accelerate things, okay? But on the other side, okay, sole founder is not good, but if you have 6 or 7 founders, it's also not good. It's very bad. And this is a personal opinion again. One thing that happens with too many founders is that it takes forever to make decisions. Then you have a very high risk of the key person, the guy that actually is smarter than everybody else and does most of the job, to get discouraged and jump from the ship. It's difficult to separate roles. A lot of people are confused in this one. And the equity split is difficult to make everybody happy. It's difficult, to control all the checks and balances. And for an investor, the burn rate is too high, which means that they spend a lot of money on salaries for the founders, and it's not an investment that, it's a favorable one. That doesn't mean that this is right or this is wrong, or you should have, a team of 3 instead of team of 5. There is no right or wrong formula here. It's just my opinion on the team. Now, the other thing that is very common is that you guys you can hear me well, because sometimes the microphone comes on and off. It's all good? Okay. So the other thing which is very common is that a business guy is going to come with a marketing guy or with a sales guy, and they're going to be like, we're starting a company, we want money. You got to have a technical founder on the team, okay? It's a startup that you're building. Chances are it's going to be in technology. A guy who's business savvy, he cannot write code. A guy who's technical, he can also be a visionary, and he can also do execution tasks. So don't be afraid to have a techie guy from the beginning. It's expensive to acquire them later down the road, and it's a hard cost that the company needs. And if you look at all the successful big companies in the Valley, they all had a tech guy in the team. If you look at Facebook, with Zuckerberg, who was writing code, or Apple with Wozniak, or with Microsoft, with Gates and Paul Allen. So there's always been a techie guy. There are very, very, very few exceptions with a company that was started and was only with a marketing and a business guy. Then, what is very common is people who are experts, let's say, in restaurants, and they come and they want to start, in business in sports. So that's that's not something that we like. We want to see a team that they own their domain, they understand their space, they have experience in what they want to build. So the guy knows their sector because that's going to help them with understanding the market uh, in general, and they're going to have a competitive advantage in compared with somebody else who would want to do it. These advantages might be access to sales, or it can be economies of scale for the product, or it can be a database that they have from a previous work where they can go and sell much faster than the next guy. You got to show you're much better than your average, guy who's going to try and get into the market. It's always very appealing to see entrepreneurs to come with no track record at all. It's important to have experience in building a company in the past. And it doesn't mean that if you build a company, it has to be a successful one. It can also be a failure. I have failed in 2 companies. It's fine, but what I've learned is invaluable, and I've used it not only in my next one, but also in the way that I make investments. So you have to have also some good record of working with people. Okay, you got to be a team player. That sounds simple and self-explanatory, but you're going to be amazed by looking at how many people they can work with other people, and they want to do everything on their own. One other sign that shows that you have a good record is if you've ever been funded in the past. I want to know that your investor, a previous guy who funded you, still likes you, because if they don't, that means that something happened there. Would they invest in you again? Is it something that they would do? Would I be able to just call them and ask them, what do you think of this guy, and be like, this guy's good and he knows what he's talking about, and we're going to invest with him. And then in the end, some people have had some exits, which is always a good thing. We're favorable to that, but it's not important. So my feeling was good, huh? Now better? Okay. So it's the same thing when you go and you choose a doctor. If you want to go in a pathologist, basically you're going to go and ask your friend, you got a doctor that you can recommend. Has he been to medical school? Does he got, some references? Or is he a charlatan and he doesn't know how to operate me? So it's the same thing. You just need a track record. Basically, you want to give your money to some people that have a track record of spending it, in a wise manner. This is also very, very common, which is part-time founders. It's people that, they want to start a business and they say, yeah, I'm going to keep my day job, and then whenever things go well, I'm going to quit my day job and I'm going to go in my startup. It doesn't work that way, guys. Especially, you got to keep in mind that those that want to start a business and they don't quit their day jobs is because they know deep inside of them that they're not going to do well. So why would I give them, my money if I know that if I know that they know that they're not going to do well? It's the same thing that, if you're married, you are cheating on your wife. It's the same thing. You want to start a company, but you don't want to leave your day job. So in the end of the day, you got to be committed. You got to be dedicated and determined that you believe in what you're doing. And last but not least, and it's my personal motto when investing, is that I don't want to invest in douchebags. That's, it's my #1 rule. I don't care about, if their idea is great or if their market is huge. If they're a douchebag, end of story. And I'll tell you what I mean. So don't invest in people that you don't respect, and don't invest in people that don't respect you. And also, don't invest in people that don't respect your investors' money. It's very important. Invest in people that you want to hang out with, and invest in people that are genuinely nice. Because if everything goes well, chances are that you're going to be stuck with each other for 7 to 10 years. Okay, most weddings don't last for 10 years. So, so it's more than just a check. It's about, building a relationship with someone that, you're going to be together for a very long time, so you better like him. Now, let's talk about the market. We talked about the team. Now let's talk about whether, the people need or they like what you're building. I have seen in many, many cases fantastic founders, smart people with very nice products and ideas, but are after a very, very small market, which is fine. It's fine for an angel investor maybe, but it's not fine for a fund, because a VC fund, they need to make their numbers work, because we're aiming at a 10x at least, in some cases, 100x, because the idea of a home run that one of our companies is going to do 100x and it's going to give us the whole fund is different than the idea of an angel investor where he's going to put, a small sum into a company and is happy with a 2x or a 3x. So when we see a small market, even though everything else looks great, it's a no-go. In general, keep in mind that VCs want to help you grow. You cannot help somebody grow in a small market. They can only grow in a big market. So, and also you have to keep in mind that usually your market is a fraction of what you have in mind. People have in mind, a market of, let's say, $3 billion. Your market might be 1 or 2. So you got to look at your TAM, meaning it's a total addressable market. There are a couple of ways of approaching this. It's a top down and the bottom up, and you got to see how you can get into, let's say, 100 million revenues in 5 years. So, as I said, it's a numbers play. It's a numbers play, and the numbers need to make sense. The other thing is that a lot of entrepreneurs, they come to us and they're like, our market is XYZ gazillion of dollars. No numbers to back that up. That's also a big turnoff. You have to be able to go and measure your market and measure in different ways. You got to start with your TAM, which is a total addressable. Then you got to go in the SAM, which is it's serviceable market. It's a market that it's of service to the people that you're offering to. And then at the end, you have to go and find which is obtainable on that SAM, which is called the SOM. And that means being very precise with your numbers and trying to show that you can, you can go and break down your market and do your homework. If you cannot do that and you just inflate your numbers, it means that you either don't know what your market is, or you don't understand what your business model is and works like, or both, which, in both cases, it's not investable. And this is something that is not easy, of course, to do, because if you don't know, if you're a pre-seed, an early stage firm, it means that most probably you don't have, numbers, you don't have customers, so it's difficult to estimate it, but again, you got to give it your best shot. Now, that's also very common. How many times I've seen a deck, and everything looks good, and on the competition slide, they're like, we have no competition. So most entrepreneurs, when they're young, basically think that this is a good thing. It's not. Not having a competition, it means that no one needs your product. I'm sorry to say that. So chances are that if the idea is good, there's going to be competition, indirectly or directly. If there is no, it means that there's no customers for what you're building. Instead of saying that there's no competition, just go and focus on the value of the business and the model of the business, and show them why you're different and why you can do much better than the next guy. Don't say that we have no competition. it's a turn-off. I'm just telling you as an advice. The other thing is that on the projections, I see slides where they're like, my market is X billion of dollars. Okay, it's $10 billion, and I'm going to target 10% of the market, which means that in year 4 or 5, I'm going to have $1 billion in revenues. It's not how it works. I explained that in the previous slides. So if you combine those, you can understand why it's a turnoff. In general, you got to be able to back your story and back your numbers right, okay, and get ahead of your game and show the investors that you do your homework and you do the work that is necessary. Then, many times you're looking at a company that, no, we invest in the US, okay? If I see a company in New York or in San Francisco, it's better. If I see a company in South Dakota, chances are I'm not going to be very eager to go and invest unless they want to move to a tech hub. And the reason is that if you're in a tech hub, it's easier to hire people, hire talent because everybody's there. It's easier to go and gain users because these users are those that actually are more eager to go and try new products and new applications and new services. And it's easier to go and raise my next round of financing because all the funds are there. So there are no funds in South Dakota, which might be a great idea, but you have to move, to Boston or New York or SF or LA. But that doesn't mean that if you're not, in San Francisco, you're not going to make it. There are many examples of firms that were in the middle of nowhere and they made it because they moved out when they had to. So you can make it. You just have to, you have to go and try harder. And also, each continent has its own hubs. So I would assume, in Malaysia, you're in the right place, is what I heard. And, in China, there's a lot of companies, and in India. So you got to find what the hub is and go there. Now, let's talk a little bit about the product, which is the third sector of evaluating a company. So the first thing is that what I'm looking at is I want to make sure that the entrepreneur is solving a real problem, and it's a simple thing. So if they're not able to go and explain what they're trying to build in 2 minutes or 3 minutes or less, and they need like half an hour to explain it, that's a problem. Even the most weird and complicated ideas eventually solve a basic human need, which is why they have a big audience of customers. Because if they didn't, they wouldn't. So I'm going to give you a couple of examples of 2 of our companies. So one of them is Lexan Bio, who we invested about a year and a half ago. What they did is, what they do is liquid biopsy on cancer patients. It sounds complex, right? You didn't understand anything, yeah. So what they do is very simple, okay? So a patient that has cancer doesn't know which treatment is working best. So they developed a patent in San Diego, and what they do, they're gonna take a sample of your blood, and they're gonna see if you need to do chemo, or if you need to go and take this type of medicine, and immediately you're not gonna waste as a patient 6 months of trying different kind of chemos and medicine, okay? So it sounds that it's complicated, but it's very, very simple what they're doing. That's what I mean. Another one, it's a company that we invested, it's called Snaps. So Snaps, it's a CMS SaaS-based solution on messaging platforms. Again, it sounds very complex, but it's very, very simple. So the thesis of Snaps is that the biggest media on the planet now, it's not TV, it's not radio, it's the messaging platforms. A couple of billion people a day use WhatsApp, Messenger, Viber, Skype, Kik, Kakao, Tango, WeChat, okay? So they are the first company to actually monetize for big brands these platforms. And they started with emojis. I don't know if you've heard the emojis that Kim Kardashian did. They made it. Or Usain Bolt, okay? And then for other brands like Starbucks and Burger King and Nike, et cetera, et cetera. So they advertise these brands on 2 billion people a day with emojis and now with chatbots. So sounds, it's complicated, but it's very simple. It's advertising in a lot of people, okay? Yeah, and people have a tendency in general to believe that, if my idea is complex, I'm going to sell it better. It's not true. Then don't invest in things that have no barriers to entry at all, okay? It might be a great idea, but if the next guy is able to go and do it in a big market, chances are, if your idea is good, they will do it. So you got to create some barriers, some big, no IP, no differentiation in the product. Everybody's doing the same thing. No customer loyalty, no tech differentiation, no use of economies at scale at all, no access and sales channels. If you have a company and none of this can make your average next guy to go and do the same thing, don't do it. Or think about a few ways to actually be protected. The other thing is that very often we come across, founders and decks with no traction at all. We need to know that the people, they like what you're building. They like your service or product. We need to know how many users you have. And we also need to know if they're paying for it, because it's one thing to have some users, it's another thing that they pay for it. Then these users, are they going to come back and pay some more? Am I going to have retention? And then are these users going to bring their friends on the platform? These are things, small signs in the beginning of a company that will make a company investable or non-investable, okay? And then, if you're able to go and capitalize on the retention and start building new features, that's also a very big extra. Now, this is also very common. Lots of decks, and they have, and you ask them, how are you going to make money? And they're like, oh, there's so many ways I'm going to make money. I'm going to, sell ads, and then I'm going to sell subscriptions, and then I'm going to have an enterprise version of my software, and then I'm going to sell license fees, and then I'm going to make a commission of every transaction, and then I'm going to have a database and I'm going to sell in ad networks, and we're going to make a lot of money. That's bullshit. You have to have, specific monetization strategy, simple and clear, that's going to get you to a specific amount of money. So look at what Uber and Airbnb does. So I'm giving these two examples because you all know these companies. They just take a commission of every transaction. That's it, period. Okay? That's attractive, not that. Now let's talk about business models that are going bad. In general, it's very users, they tend to entrepreneurs, they tend to overestimate how easy it is to acquire users on their platform. And they don't pay attention in their money. They don't care if the customer acquisition cost is bigger than the LTV, which, as you all know, I hope, is very bad. You got to make sure that you can scale fast enough, okay? And you got to find a way where you can monetize your users at the value of the dollar, which is bigger than your cost, than what it costs you to get a customer on your platform. So I'm going to give you a couple of examples, then and now, where a business model was bad. I don't know if any of you know Webvan, or you've heard of it. Okay, maybe not. So It used to be a very, it used to be a company in 2000. I was a student in San Francisco back then, and I would see I would see vans of web van in every corner. Basically, what they did was the delivery of groceries, okay, in San Francisco. These guys burned about $800 million back then, which is 20 years ago. You can imagine about $1 billion. It's how much money it is. So what they did, the biggest mistake I think that they did was the timing. So who else did the same thing a few years, later, and they did great? It's called Amazon. So, bad timing, because with Webvan, a bandwidth was not there, so it was only a few people in their houses had DSL, and the mobility was not there. So, people, they didn't have smartphones, so they could order, like with Amazon now, from their car or from the street. So that means that their market was very, very small, okay? And their pricing strategy was wrong, and the target, audience was wrong also, which made it a big failure. I would imagine that if they tried to go ahead and do this, a couple of years ago, it would be a different story. And now a business model that is going bad, and this is my opinion, I hope I'm wrong, is Snapchat. You all know Snapchat, I guess. So, Snapchat, they haven't made any money since, I don't know when. Basically, last year, they lost $500 million. And they're public now, which means that there is more pressure for their investors to make money. They have a very small user base. It's only about half of that of Twitter, and less than 10% of that of Facebook. So that's a lot of pressure there. And unfortunately, they have no unique value prop, because they have no real tech. Whatever new feature that they make, Instagram and Facebook, and next day is doing the same thing, and they offer it to a couple of billion people. So deal with that. It's impossible. And how do they make money? They sell ads, okay? I don't know if you know, but Google ads and Facebook ads, they control 90% of the market share of the ads in the whole, internet. So how are you going to compete with that? So I think that this is bad business model. We'll see. So that's just my opinion. Now, we also see a lot of companies that start with very high overheads. That means that your margins are going to be small. So you got to try much harder, if you wanna have good margins. It also shows that you are making very poor use of funds, and you got to keep in mind that your overhead is always, it's going to be much higher than what you think it is, but you got to make sure that you're going to keep it, it's not going to get out of hands. In general, by having a very high overhead, investors see that you don't appreciate their money, and they want to see that their money is greener than the next guy. So by doing that, they're not happy. No marketing plan. If you see a company that has, they only do paid ads, it's a no-go. Especially, we want to see that they do some content marketing. I don't know if you guys know what that is. It's basically, if I pay to have an article about, in a health magazine that it promotes Whole Foods, okay? So, or there are no network effects, which is difficult nowadays now with all this clutter with apps. No partnerships, let's say I have, I want to build a device for exoskeleton, which is for people with disabilities. If I go and pitch myself to a fund and tell them that, I have a partnership sign with a clinic, that's a big plus, because I know it can boost sales from day one. and no brand development. So this is what happened with Tesla. So they were able to go and align their brand with what they offer, which is electric car, unique design, extremely fast, and the iPhone of cars, let's say. Yeah, so chances are your app or your product is not going to go viral. A lot of people start with this hope that it will be viral. It will be a bit, viral. Chances of that is zero. I'm not kidding. It's close to zero. Okay, and then it's the fundraise, which it basically shows as an investor what's the risk on my capital. If I give you money, am I going to lose it or not? So lots of companies, they come to a fund and they have a very high valuation. So you got to remember here that a VC is looking for at least a 10x or 100x in some cases as a multiple in the investment. When you start with a very high valuation, the chances are that you are going to run a risk of a down round because no one else is going to be able, is going to want to give you money in the same high valuation as they did in the beginning, or you're going to be unable to go and raise more money, which means that I'm losing my money. In general, what you want to do is you want to raise enough dollars so that you're not going to lose your company, and you want to make it attractive to the investors, those two at the same time. That's also very common. You go and you meet an investor and you exaggerate on the potential of your company and how it's going to do. And this is fine. I mean, it can work with your mother in the kitchen, be like, hey, mother, I'm building a next Facebook. Or it can work with your buddies that are accountants, but it's not going to work with investors because they know what they're talking about. So in general, you got to listen with, you got to talk with your customers, you got to listen to them, okay? And you have to be, you shouldn't be in love with yourself, okay? And listen what other people are saying. In early stage investing, as I say here, we're more interested in evaluating the founder, not the idea or the company, okay? And that's a line that I saw on the web, and I liked it. Don't be optimistic, the line at the end of the tunnel, it might be another train, so be ready for a comp. Then, some people are going and they raise a lot of money, some people they're going to raise a little money. It's important to know how much money you want to raise, and it's important to know why you want to raise this amount of money. Where is it going to take you? Okay, you have to be able and calculate how much runway you're going to get with the fundraise. Okay, and you got to know your burn rate. These are the first questions we basically ask when we see a company. How much money you got in the bank now? Okay, let's say I'm going to give you an example. It's a common example. How much money you got in the money? I got 100K. Okay, that's fine. And you're closing your fundraise in a month. Okay, how much money you want to raise? I want to raise 600K or 800K. Okay, that's going to give you, if you burn 100K a month, it's going to give you a runway of 8 months. It's borderline. It's not enough. On average, you want to have a runway of about a year, from 8 months to a year, at least. So this is very important to go and calculate before you go and talk with an investor. What happens now? If you raise a lot of money, eventually, and if you do well, eventually there's going to be a conflict between the entrepreneur and the investor. Let's take one example, okay? You are raising, let's say, $8 million on a $20 million valuation, so that's a 30 million post-money valuation, which means that if we're looking at a 10x as an investor, we want to see an exit at 300 million or 280, okay? And then you get an offer for 60 million, which is going to make you happy as an entrepreneur because you're going to make some money on the side, but it's going to give me 2x as an investor, which is something I don't want. It's unacceptable for my LPs, for my investors. So that's a conflict. I'm not going to let you sell at this price, okay? So that's a problem that might occur when you're raising a lot of money for no reason. And then on the other hand side, there are cases where some entrepreneurs, they are afraid that they're going to lose equity and they want to raise a little money just, to get them onto the next step, which is fine, but it gives you very small room to make, any mistakes. If you need to go and pivot at some point because your idea, is not performing, you're not going to have a flexibility to do so. So if you don't have enough money to go and reach milestones that are necessary for your company, you're not going to raise more money. That's the end of it. So bottom line, you got to raise as much as you need, and don't worry, you can always go and raise more later, okay? Then, poor use of previous funds. Investors, they know each other and they talk with each other. Even in New York, where we work, it's a small market. It's a lot of companies, but the good investors are, a bunch of companies that they know each other. So if we know that, this company is spending a lot of cash and burns a lot of cash in acquiring customers or in marketing or hirings or PR, it's not going to give you, a good pedigree. Being aggressive with the growth is fine, but when the environment changes, you got to change as well. Look at Uber, or look at smaller companies where sales don't go as expected, or your key engineer is leaving, or a gazillion things might happen. You got to change also. Investors, they look at your past and they don't want to see a big spender. What also happens many times is that, some investor I know has invested in the pre-seed round, and we come in later on the seed round, okay? And we see that the early investor doesn't want to follow on. Usually that's a bad sign. It's one of these, few reasons. So number one, they don't think that you can make it. Bad sign. I'm going to find out. It's not good. Number two, they're not happy with their relationship so far with the entrepreneur. Also, it's a bad sign. Or number three, they think it's too soon and you're not ready to go and fundraise. Now, there might be also that the fund is deployed, and they don't have other funds for investments at the moment, which is neutral, or you're doing so well and you're oversubscribed and you're getting the big guys, you're getting Andreessen and Sequoia, and you don't want to be talking with your pre-seed investor who just helped you, which is great, and then, big thumbs up. But usually it's one of the three above. And last, in general, an investor wants to see some skin in the game. And by saying skin in the game, usually people think of money. It's not always money. It can be a few other forms of currency here. It can be time, or it can be opportunity cost. Let's say what we talked earlier about a part-time founder. He doesn't give in his time or his opportunity cost. It can be social or human capital. Or, what I prefer, it can be all of the above. And in general, when you have skin in the game, chances are you behave differently. These are some stats. Basically, I don't know if you can read it, but here it says that of the founders that failed on the first company, 2 out of 10, they succeeded on their second. So that comes down to this bullet point I had in the beginning about saying that don't be afraid of failure. You can do it again and again, and eventually You know, if you believe in yourself and you build a good team and you do all the things that we talked about, eventually you can do it. So, bottom line is that we want to see a team with a track record, you know, that invests in a big market, that solves a problem that exists, okay, that has a clear strategy and a vision, that can scale really fast with an obvious revenue model and a path to an exit. It's always important to have a path to an exit in your head. Otherwise, don't go and raise money. Use your own money and, you know, and keep your company. And what we don't want to see is we don't want to see inexperienced teams that go after small markets, that don't really solve a problem, that they don't have a clear identity and vision, and they don't know how to gain market share. They have lots of monetization streams or none, and they have a market that don't need their product. So, with that being said, is that spelled right? It's Habachy. Thank you. Thank you.